It wasn't a simple market correction. It wasn't a sudden surplus in mining supply. It wasn't even a failure of industrial demand. It was the systematic demonetization of a tangible asset to pave the way for a debt-based standard. The crash you see on the charts is not just a loss of value. It is a transfer of wealth. The pattern is unmistakable. The arithmetic is merciless. When a monetary medium is stripped of its role, the initial result is a collapse in price. But the secondary result is a violent repricing as the substitute currency fails. We are watching a mechanism that has run for centuries. The suppression of silver prices is not a modern conspiracy. It is a historical necessity for any empire attempting to operate on credit rather than capital. To understand where silver goes by 2026, you must understand why it was crushed in the past. The incentives are clear. If the people hold silver, they hold autonomy. If the people hold debt, they hold dependence. Under these constraints, the rational move for any state is to channel liquidity away from hard assets and into sovereign bonds, but history shows this channel eventually breaks. The pressure builds. The dam cracks, and the water finds its level. We are not looking at a random fluctuation. We are looking at the end of a cycle. This pattern has destroyed fortunes before. It has wiped out savings before, and it follows a specific sequence. First, the physical asset is marginalized. Second, a paper substitute is introduced. Third, the paper substitute is inflated to cover imperial costs. Fourth, the physical asset reasserts its value in a chaotic reset. This is not a theory. It is the documented history of the Roman Empire. It is the documented history of the Spanish Empire. It is the documented history of the Weimar Republic, and current data suggest we are nearing the mathematical limit of the current paper epoch. The only question is not if the price corrects. The question is, who holds the physical metal when the paper claims are extinguished? Let us examine the evidence. Consider the Roman Empire, specifically the crisis of the 3rd century, which began not with a bang, but with a subtle adjustment to the silver content of the denarius. In the 1st century, under the reign of Augustus, the Roman monetary system was the envy of the known world, anchored by a silver coin that was nearly pure, containing approximately 3.5 grams of precious metal. This coin was the bedrock of trade from the foggy coasts of Britannia to the spice markets of Syria, a universal standard of value that allowed a soldier in Gaul to purchase wine from a merchant in Naples without a second thought. But the costs of empire are relentless, and the temptation to cheat the arithmetic of scarcity is a siren song that few emperors could resist. By the time Nero ascended to the throne, the fiscal pressures of maintaining the legions and rebuilding a fire-ravaged Rome forced a decision that would echo through history. Nero did not raise taxes, for that would risk rebellion. Instead, he reduced the silver purity of the denarius to roughly 90%. It seemed a small, almost imperceptible change, a clever accounting trick that freed up silver to mint more coins and pay more debts. But the incentive structure had shifted. Once the precedent was set that money was defined by the state's decree rather than its metallic content, the slide into debasement became a landslide. Fast forward to the reign of Septimius Severus in the early 3rd century, and the silver content had plummeted to 50%, yet the face value remained the same. The soldiers, the backbone of imperial power, began to notice that their pay bought less grain, less land, and less security for their families. By the time of Claudius II Gothicus in the year 268, the once proud silver denarius had been reduced to a zale, copper slug washed in a thin, pathetic coating of silver, containing barely 2% of the precious metal. Consequences were not merely economic, they were social and catastrophic. A Roman centurion who had saved his wages for 20 years found that his retirement nest egg was virtually worthless, wiped out not by theft, but by policy. The middle class, the shopkeepers and artisans who held cash were obliterated. The only survivors were those who had traded their debased coins for land, for cattle, or for the very raw silver, bullion that the state was desperately trying to dilute. The empire fractured, trade routes collapsed because no one trusted the currency, and the economy reverted to primitive barter. The lesson from Rome is stark. When the state cannot pay its bills, it will cannibalize the currency, and the holders of that currency will pay the price. Just like the Roman debasement, the Spanish Empire of the 16th and 17th centuries fell victim to a different, yet equally destructive, misunderstanding of money and value. Spain did not suffer from a lack of silver. On the contrary, it drowned in it. Following the discovery of the massive silver deposits at Potosi in 1545, the Spanish galleons began to ferry mountains of precious metal across the Atlantic, flooding the European continent with wealth that seemed infinite. The Spanish crown, led by rulers like Philip II, believed they had discovered the ultimate cheat code to geopolitics. They could simply buy armies, buy navies, and buy loyalty with the endless stream of silver flowing from the New World. But they confused money with capital. They believed that the silver coin itself was wealth rather than the productive capacity of their economy, as the silver poured into Seville and spread throughout the Habsburg domains. It chased a static supply of goods. The result was the price revolution, a period of relentless inflation that baffled the economic thinkers of the day. A pair of shoes that cost a few maravedis in 1500 cost hundreds by 1600. The influx of silver did not make Spain rich. It made Spain expensive. The Spanish industry hollowed out because it was cheaper to import goods from France or the Netherlands than to produce them domestically. The incentive was to consume, not to create. The crown, drunk on this liquidity, leveraged itself to the hilt, borrowing against future silver shipments to fund endless wars in Flanders and against the Ottomans when the shipments were delayed by storms or pirates, or when the mines eventually began to yield less ore. The entire house of cards collapsed. Philip II, the master of the world's greatest empire, was forced to declare state bankruptcy, not once, not twice, but 4 times, in 1557, 1560, 1575, and 1596. The holders of Spanish government bonds were wiped out. The merchant bankers of Genoa and Augsburg, who had lent gold and silver to the crown, saw their assets vanish. The Spanish peasant, watching bread prices soar while wages stagnated, was forced into destitution. The abundance of silver, mismanaged by a state that did not understand the laws of economics, led to a paradox where the richest empire on earth was perpetually broke, and its citizens were crushed under the weight of an inflated, distorted economy. Just like the Spanish illusion of wealth, the Weimar Republic in the early 20th century provides the ultimate case study in the final detachment of money from reality. In 1914, Germany suspended the convertibility of the mark to gold and silver to fund the First World War, betting everything on a swift victory that would allow them to pay off the debt with the spoils of conquest. They lost the bet. By 1919, the new Weimar Republic was saddled with crushing war reparations denominated in gold marks, yet their industrial heartland was decimated, and their treasury was empty. The constraints were absolute: pay the reparations or face occupation. The government chose the path of least resistance. They turned on the printing presses. At first, the inflation was uncomfortable but manageable, a creeping tax on the saver. But by 1923, the mechanism had escaped human control. The state began to monetize debt on a scale that defies comprehension. The price of a loaf of bread, which had cost 160 marks in 1922, rose to 200 billion marks by late 1923. The tragedy of Weimar was not just the numbers. It was the human cost of the delay in recognizing the shift. The middle-class family that had dutifully saved in government bonds and cash savings accounts saw generations of accumulated wealth evaporate in a matter of weeks. A lifetime insurance policy payout was not enough to buy a single cup of coffee, however. Those who understood the pattern acted differently. They did not hold marks. They held foreign currency, they held industrial shares, and most importantly, they held physical gold and silver. There are accounts of Berliners rushing to exchange their wheelbarrows of paper money for a single silver teaspoon. Because the silver teaspoon retained its purchasing power, while the paper note became kindling for the stove. The crash of the paper mark was the inverse of the moonshot of silver and gold. The value of silver didn't change, the measuring stick disintegrated. The outcome was a total social fracture, a radicalized population, and a vacuum of authority that was eventually filled by a totalitarian regime. The pattern repeats in 7 distinct stages. Stage 1 is the sound money era. The currency is backed by or composed of hard assets like silver or gold. Trust is high, inflation is low, and the economy grows based on savings and production. Stage 2 is the expansion of claims to fund wars or social programs. The state begins to issue more paper receipts than there is metal in the vault. The population does not notice because the paper still trades at par with the metal. Stage 3 is the suspension of convertibility. A crisis hits, a war or a depression, and the government temporarily severs the link between the currency and the metal. They promise it is a short-term emergency measure. Stage 4 is the fiat drift. The emergency measure becomes permanent. The currency floats freely, anchored only by confidence in the state. Inflation begins to tick up, but it is dismissed as transitory or a result of supply chains. Stage 5 is the asset flight. Smart money realizes the currency is being debased. They quietly move capital into land, art, and precious metals. The state often responds by suppressing the price of these metals through futures markets or regulations to maintain the illusion of currency. Strength. Stage 6 is the crack-up boom. The public loses faith. Velocity of money spikes as everyone tries to spend the currency before it loses more value. Prices of hard assets skyrocket in nominal terms. Stage 7 is the reset. The currency collapses or is redenominated. A new system is introduced, often backed by a hard asset or a new form of control to restore confidence. Just like the stages observed in Rome, Spain, and Weimar, current data suggests we are deeply entrenched in Stage 5 and showing flashing signals of Stage 6. The mapping is precise. We have seen the suspension of convertibility in 1971. We have seen the fiat drift of the last 4 decades, and now we are witnessing the asset flight, the suppression of silver prices through the paper derivatives market, where billions of ounces of paper silver are traded daily, vastly exceeding the available physical inventory mirrors. The Romo attempts to mandate value by decree. The crash or stagnation in silver prices despite record inflation is not a paradox. It is the mechanism of Stage 5. The incentive for the current financial structure is to keep interest rates lower than inflation, to burn away sovereign debt. If silver and gold were allowed to rise freely, they would act as a smoke alarm signaling the burning of the currency's purchasing power. Therefore, the alarm is muffled, but the physical constraints are tightening. We are approaching 2026 with a supply-demand imbalance that history has never seen. The industrial demand for silver critical for solar panels, electric vehicles, and 5G. Electronics is devouring the above-ground stocks. We are moving from a monetary suppression dynamic to a physical shortage dynamic. The arithmetic is merciless. You cannot print silver when the industrial users who need the metal for production start competing with the monetary investors who need the metal for protection. The paper price mechanism breaks. You must look at the counter-argument. Many economists argue that modern central banks have tools that Rome in Weimar did not. Sophisticated algorithms swap lines and the ability to manage inflation expectations. They argue that silver is a barbarous relic with no yield and that digital assets or equities are the superior hedge. But this argument fails to account for the counterparty risk. Equities and bonds are liabilities of another entity. Digital assets, while promising, are still tethered to the liquidity of the fiat system. Silver is an asset with no counterparty risk. The incentive for central banks is to maintain the system, not to protect your purchasing power.